But
Hey everybody, it's Shauna the Tax Goddess. I am so excited to be here today with our fantastic cost seg expert, Mr. Bill Smith. This way, Mr. Bill Smith.
that's it. Yeah.
Hi. So, we get this question over and over and over and over again, Bill, right? Of course, as tax strategist, I want to reduce my taxes. How do I do it? Now, cost seg, how long has cost segregation been around?
Great question. Since 1986 and the change in the tax law where the IRS redefined depreciation and kind of changed it for a lot of people. But it's been around for a long time. And the audit techniques guide, where they actually defined what they do in the audit, came out in 2004. So,
Okay.
but segregation in general, since really 86.
I was going to say 86. We're almost at 40, 50 years. We're almost at 50 years. Long time, very long time. So cost seg is one of those strategies that, if it's been around that long, the IRS has gone through it, the courts have gone through it, right? Let's back up here for a second. Help me understand, if I know nothing about what this word means, what does cost segregation mean?
What we do is we take a building, the whole building, and segregate it into its component parts, basically breaking it apart or dissecting it and then giving a life class to those individual components. So instead of 39 years for a commercial or 27 and a half for residential, for everything, we identify certain components, and the interior components might be flooring and built-in specialty lighting and specialty components, or landscaping as exterior. So we break all those out with a separate life, and then with a shorter life, then you have bigger deductions. It just pushes them forward. So it's a deferral strategy. It's a tax deferral. These deductions now have a shorter life, which means you can have bigger deductions and pay less taxes.
We like bigger deductions and pay less taxes. Always one of my favorite pieces here. I love it. And so now, big safe taxes, bigger deductions for who? Like who does cost seg really apply to?
Well, depreciation normally is a passive loss, right? So it's a passive loss, passive income. So rental income is your typical passive income. Royalties, people that are getting K-1s from their business, they retired, but they're still getting paid. That's kind of passive income. And so it only offsets passive income unless you are a real estate professional, or you follow what's called the short-term rental loophole, or you can manage your own short-term rental, which a lot of people are doing these days, which I'm doing myself. So I have a lot of tax opportunity there. I see your dog back there. He's so cute. And so with that, then the passive loss can go against ordinary income. So like you or a lot of my clients, you've got a high earning doctor, consultant, something making a couple $1,000,000 a year. Spouse says, kids are kind of in school now. I'm going to manage real estate and get these big real estate deductions, which they can then offset as a real estate professional, offset ordinary income. So I have a lot of clients that do that. A lot of people are just straight real estate people, or doctors or CPAs that have their own office. They rent their own office, and there's the self-rental rule, which you're very familiar. So that's also another way that you can take passive losses against ordinary income of that business, right? So that's kind of the third way you can kind of hit that trifecta of opportunity.
And I think that's really, that's a key piece. We're covering it here very quickly, but understanding which of these categories do you fit into, right? Can you work with a real estate professional? Can you meet those qualifications? Can you do the short-term rental thing, right? There's quite a lot of concern about the short-term rental market at this point, right? There's so many of them, and people are having to convert them to long-term rentals, and that loses some of your deductions, that kind of thing. So one of the big pieces that I absolutely loved about what you said to me once, Bill, was how do you know when you should or should not do cost segregation on a specific property?
All right. Well, that's where I counsel people, and I always ask them, okay, can you use it? This is a passive loss. And if Shauna sends them to me, I just say, usually they know they can use it, but I always just check and see, okay, and so I have to kind of do some of that education to make sure they can use it. But the other thing is, then if you have a building that, is on the fence, because most people say $1 million or more, you do a cost seg. Under that, it's not worth it. Well, as you know, we have a software solution, DIY Cost Seg, that is for smaller properties. And so when I look at those, it can go down to $100,000. I've done properties under $100,000, rental homes, small rentals, college rentals, things like that. Hard to find those now. But there's a math equation that kind of says, okay, at what point do you go from the automated software to a full study. And it's really about math and depreciation because the software tool is inherently conservative by 5, maybe 10%, depending on the property, because we're not inspecting and we defend you if there's an audit, which is very important as defense. And so, as I told you before, I look at the house or the building and I say, is there building bling? Like, for lack of a better, like, okay, is there pizzazz? Are there like stuff hanging on the wall? There are built-in cabinets, crown molding, specialty flooring, built-in bars and drop ceilings and all those things. The more of that you have, the more you're going to drive depreciation. So if it's an ordinary starter home, Ryan starter home house, I mean, they're fine houses. There's not going to be a lot of building bling in it. But if it's a nice house in Paradise Valley or somewhere, Beverly Hills or whatever, there's like nice stuff and then nice landscaping. So then you say, okay, at 500,000, if you've got a blinged out house, well, that might be 50,000 more in depreciation. So the added fee from the $740 for DIY, which includes audit, to $5,000 for that. I mean, that 50,000 for 4,000 more is probably worth it if you're mining for depreciation. So I counsel people and say, I'll do either one. And then once you go over $1 million, it's like pretty much you're going to want to do it. But like a warehouse has very little bling. So a warehouse is like,
it's a box.
That much. It's just a big box and store. Unless it's used for assembly or manufacturing, they're bringing a lot of power in, then there's a lot of money. But if it's a big shell building that's got metal shelves storing boxes for distribution, there's not a lot to cost seg.
Well, and we hear this a lot with doctor's office, dentist office, right? Where the building bling, I mean, they're putting in custom dividers, walls, sinks, the cabinets, all these kinds of things. So especially if you own that business and you own the building that business is in, getting that cost seg, writing it off in the first year, doing that aggregation, could be huge for you. It could wipe out your entire income for the whole year. It could be massive.
Well, they do well. And as you remember, the very first job we did for you, like 13 years ago or 10 years when we met, was that your veterinary, he bought the building and he killed it. He got so much. I had a kid going to college. He goes, I need to have some. And we found umpteen thousand, 100,000 of deductions for him. So we solved it. So doctors' offices, again, like you said, do well because they all have a sink. All the offices, they have built-in cabinets. They got plumbing and things for that. That really makes a real difference is that building bling.
Gotta love building bling. I'm in love with it. I feel like there should be an extra little sparkle on the report or something in the corner. Building bling, I love it. All right. Well, so, one of the questions that comes up here is, listen, I've inherited a property. Maybe they did cost seg in the past. Maybe they didn't do cost seg. So what are the differences if I've inherited a property? How does that work?
Well, that's a great question. When you get doing an inheritance, you get a step up in basis. So you got it from your mom or dad, and you got this property. Excuse me, I'm rubbing my eye. It's bad for the camera. Can you edit that? And so then they bought it for 200,000 years ago, and now it's worth $1 million, right? Because it's been a long time. It's in Scottsdale or something like that. So now they get the building at $1 million, and you can do a cost seg on $1 million. Whether the cost seg was done before or not, whenever there's a change in ownership, it starts over. So I could buy a property today, cost seg it. Then you come tomorrow and say, Bill, I want that property, and I'm going to give you, you bought it for $1 million, but I'm going to give you $1.5 million. And so it's 6 months later, I'm like, $500,000. Okay, I'll take it. I'll sell it to you, and then you can do cost seg for $1.5 million. It doesn't matter. Now I'm going to have recapture, which is another thing that people can be fearful of, which is shouldn't be, but in some cases, of course. But so that
if you have a goddess on the team, do not fear recapture. There's a million ways around recapture. So there you go.
You just buy more property. You just buy more property. It's like defer. It's kick the can down the road.
Kicking the can.
Just like a 1031 is the same thing. Cost seg and 1031. Cost seg is like the poor man's 1031. I mean, they say it's like it defers, and you don't have all the accounting and the mess, and then you're carried. If you're going to plan on putting it in 1031 and then keeping it till you die and giving it to your heirs, that's perfect. But if you're going to keep transactional, look to see if cost seg it does the same thing, because you're still putting. And then finally, when you say I'm done buying property, now I'll put it in that trust or that 1031 for my heirs.
Yeah, love it. So why does timing matter? Like what is the best time to implement a cost segregation study?
I like to say it's pretty soon after you buy it. Now, there's different. If you're buying a property and as is, do it, and especially year in service. Now, if you bought year in service and you're not a real estate professional, but you plan on being it next year, then wait till next year because you can't get the depreciation now and then convert it to when you're a real estate professional. Once you lock it in your current status, as you know, IRS says that's the way it is and you can't change it. So normally year in service because we establish a depreciation schedule on set. But we can do look back studies, as you know, we've done them for your clients. And there's that 3115 change of accounting method, which tells the IRS you've changed from straight line to component level depreciation, and it recalculates and trues up the benefit. So I say in the beginning, but if you buy it and have a lot of improvements planned, then maybe we'll wait till the improvements are done, or maybe in advance. If you're going to totally redo the building, we want to get in there and do a cost seg, because when you tear out all the stuff, do it, then you have all that disposition and expense, and a huge expense. Now, you know, I deal depreciation, but expenses come first. I mean, I got to admit that, right? And you get
all day, every day, 100%. Yeah, the expenses aren't capped, guys. I mean, unless you're passive or whatever, right? It'll offset against income. But if you're a real estate professional, those are expenses, flat out done. Right. So yeah,
those are big, and so that's really one of the things I look at is, you know, what's going to happen, what are the improvements, and then, you know, sometimes improvements might just be, you could use QIP if it's just internal and stuff like that, and take it all 15 year. If you're in 100% bonus, that's fine. If you're in your improvements are 5-year property, then and you do it now, you could get 15, but it's like, I want the 5-year, then we'd want to go back and do a cost seg. So sometimes we do cost seg, sometimes we don't on improvements. It depends. You know, you got to do enough to justify it. But the one other thing is you do it on PPA, purchase price allocation, what you bought. So as you bought it, right? You say, well, I bought it, I put in this, I put in this. No. It's as you bought it, and the improvements are separate. IRS, we have to separate those. So when we do a study, it's basically 2 control sheets, as we've done for you and your clients. One's on the purchase, one's on all the improvements, because they may or may not be in the same tax year. Yep. So that also makes a difference. And also, if you buy it empty this year, let's say you bought one today, and now you guys think you're going to do a new office, and then you're going in service on March 16th, the day after tax day, right, for you. Then you'd be in service. It'd be really next year. You wouldn't put it on your depreciation schedule this year. So that's another thing. It says, when do you go in service, not when you buy it. But if you buy it and there's still a tenant in there for a month and they pay you rent, you're in service, right? And you don't really have a choice. So it's all those little IRS rules that you live on every day. And I know a little bit.
Well, and I smile because this is why we work together, right? I have heard way too many cases where somebody just said, yep, just go get a cost seg. Wait, why? Let's understand the reasoning behind it. Let's understand what are we doing. Now, you kind of started trailing into, and of course, guys, we are filming this. We're live today, November 1st. November 5th, we should find out who's going to be our new president. Hopefully, we'll find out, I guess, you know, on that day, and here we go. You mentioned bonus depreciation. So can you kind of give us just an understanding of the difference between regular depreciation, 179, bonus depreciation? What does that look like? Because that's going to impact when you do or do not decide to apply. Even if you got the Cost Seg study, applying it may be a different deal. So yeah, talk about that.
Right. In 2018, the Tax Cuts Jobs Act established bonus depreciation, 100% bonus for acquisitions. We had bonus on occasion for stimulus, and it was usually 50%, and it was on new construction and new improvements only. Trump made it for the acquired property. The IRS calls it used property, which is just weird. You know, like, oh, I'm going to buy a used property. I mean, it's true, but it just sounds weird.
True. I mean, you acquired it from somebody else. So,
well, they call it vintage, right? Like vintage clothing. I go to vintage. I'm talking about old stuff, right? You know, like an estate sale, right? But anyway, so it established it at 100% bonus for 5 years, which means we still accelerate the same amount of depreciation. You get your same 5-year and 15-year and any other components you might have in there. It's just how much of that you can take in year one. So when it's 100%, let's say it's a $1 million property, we found 30% to accelerate depreciation on, which is all the stuff. You have a $300,000 deduction, right? That's huge. And so then it started trailing off in 23. So in 23, it was 80%. In 24, it's 60. Then it'll be 40, then 20. So this year, if you bought it at $1 million, it'll say, and you we found 10%. I'm using simple math here.
Yeah.
That's 100,000. 60% of that this year, you get the 60,000 as bonus, right? 60% of your total depreciation, and then the remaining 40% is going to accelerate over the appropriate 5 and 15 years at double declining balance. And people always go, "How do you explain that?" It's like, I don't know. It creates a bell curve. It starts good, and you can explain that better than me. I mean, I know how it works, but it's 150% or 200% depending on the 1245 or
Type of
1250.
asset, type of yeah, oh yeah. Well, and I think one of the pieces that a lot of people fail to realize is how powerful the bonus depreciation is, right? Because you've got regular depreciation, so what, just regular, no bonus, no accelerated, no nothing, right? Which is 27 and a half years for a piece of rental property, or residential rental property, 39 years for a commercial building. Okay, those are your regular depreciation schedules, 15 years, 5 years, whatever, based on the type of asset. 179 will allow you to deduct this year for 2024 up to 1.2 million, okay, of certain classes, right?
Yes.
5 years, 7 year, whatever. However, right, if you bought a building that's $4 million, if you bought a commercial building, big warehouse, lots of whatever, okay, your max cap is 1.2 million. That's it, period. You're done at 1.2 million. Bonus depreciation can apply to anything that the 179 did not apply to. So especially when you start looking at larger buildings, right? If you're in smaller buildings, you're under 1.2, you can choose bonus 179, which way do you want to go? But if you're in something larger than that 1.2 million, as far as what you're trying to write off in that year, you're kind of stuck. So without bonus depreciation of 20, 40, 60, depending on what year and when you bought it, you're stuck. So
right, well, and that brings a good question that I hadn't really thought about talking about is the 179 is really good, but people say, oh yeah, well, you can only cover $1.5 million, but you can't just expense everything. People say, oh, well, you got the 2,500 de minimis, right? Well, you say, well, in the wall is $25. Well, but that's part of the whole electrical system. You can't just take and are expensing little components. You have to have a whole system. And so one of the nice things they did it's the big ticket items. With the CARES Act, after COVID, they allowed for expensing of new roof, HVAC, fire suppression, and security systems. So they added that to the list of things, which those are big ticket items. And when you have a cost seg on a PPA, on the original, we gave you a value for that roof. And so now you have put a new roof on. Well, I can now expense the value from the cost seg, and then the new roof, I can expense that too versus capitalizing it. So those are just great things, and where when you have all the asset detail in the cost seg, then you know what you can expense, whether it's for partial asset disposition or you might pull it out for 179. So here, these things I can qualify for 179. So a lot of our CPAs will get this report, and of course the percentage it says in is take out the amount and then qualify it for 179. So that was a nice thing for 179 to add. You talked about bonus and inferred. We have an election coming up, so if Trump is reelected, there's a pretty good.
I'm hoping it'll bump back up to 100%. Let's go.
100%, and he'll probably make it retrospective. So it will go back to 2020. You can't go back to 2023, is gone, but he'll do stuff in February. And even with the Tax Cuts Jobs Act was signed in February 18, it went back to 17.
Beginning of the year that you hadn't filed.
Yeah, September 28. So he actually took it back into the fall of 17. So since having the file, it will probably be 100%, and then a lot of those things. But it's not just cost seg, and there's R&D stuff. There's child tax. There's a bunch of tax incentives that we'd like to make permanent. Kamala doesn't seem to want to do those, and so, but cost seg is still there. If she wins, you still have cost seg, and bonus will kind of trail out over the next couple of years. But we lived on cost seg without bonus for 16 years. I mean, we started in 2002. This didn't come into effect till 2018. So it's still really, really, really good without bonus. But now people are, it's like dope, right? They're like,
it's extra good.
Everybody's on it, right? People call me every fall, right? Because I'm like, you need another hit, right? I'm like a dealer. I'm like, buy another house. I'm like, I'm dealing depreciation. They're coming back every year. They go, I did another one. I'm ready for a cost seg bill. I'm like, yeah, you just can't get enough, can you? Right?
Bill, you know what? You and I could talk for hours and hours and hours. We are out of time, so we may have to do a part 2. But for those of you listening today, please, 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 we've worked with Bill for a very long time. Really, really like Mr. Bill Smith. Oh, Mr. Bill Smith here for the cost segs. And yeah, if you have real estate, especially if you're a real estate professional, if you've got the Airbnbs, if you have, and it has to be in the first year, if you have a business and you bought a building and your business is going to be in that building, get that cost seg because it's got to be on the first year tax return. Otherwise, it doesn't work. So, guys, as usual, Tax Goddess trying to bring you super smart experts over here. So, Bill, thank you so much for your time today. It's been such a pleasure to have you with us.
I really appreciate it, and thank you, and look forward to seeing you when I come out to Arizona.
Yay!
In March.
In March, looking forward to it.
All right.
Y'all have a great day. We'll see you later.
Bye-bye.
Bye.